Let me quickly talk to you about single member S Corp taxes. Everything you need to know. Don't you go anywhere. You're going to love today's conversation. I guarantee it.
One in a million, one in a million, one in a million. You know they're coming up to me, cause I'm just the kind of flower that's stinging from the beat, but the rhythm's getting higher. Go, 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 go. One in a million, one in a million, one in a million, one in a million, one in a million.
Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, I want to talk to you about single member S Corp taxes, everything you need to know. So let's start with the overview, okay? A single member S Corp is a single member LLC that has chosen to be treated as an S corporation for tax purposes. And a single member LLC is automatically considered a disregarded entity for federal tax purposes. However, it is also possible here. It is possible for you to choose to be treated as an S corporation or a C corporation if you are the owner of a single member LLC. An S corporation is basically a small company that is closely held. Very important to see that distinction here, okay? Because they are pass-through entities. S corporations are very similar to sole proprietorships and standard limited liability companies, so standard LLCs. A pass-through entity is a business where income is passed personally to the business owner so that it can be reported on the individual tax return. So if you are interested in being treated as an S corporation, you will need to fill out and submit Form 2553 with the IRS. So after you have established your single member LLC, you can elect to be treated as an S corporation anytime you wish. So now, having said that, there are certain limitations. For instance, your status as an S corporation must be effective within 75 days of filing the IRS form, within 12 months after your form was filed. Very important. If you choose S corporation status, you will need to file additional end-of-year tax forms, including Form 1120S, which is the S Corp income tax return. Both S corporations and single-member LLCs can be taxed as pass-through entities. I just said that. One of the biggest differences is that S corporations require considerably more paperwork. The main reason you would choose S corporation status is to lower your self-employment taxes while still having the benefits of pass-through taxation. So there are pros and cons. So if you're interested in S corporation, go ahead and choose it. Okay. Let me have a very quick conversation with you about the implications. So when your single member LLC is considered an S corporation for tax purposes, you no longer count as being self-employed, meaning that you will not have to pay the self-employment tax. Instead of being self-employed, you are considered a company employee. You will also be able to use company profits to pay yourself a salary. However, you may not have access to all available company profits. So any additional profits earned by your single member LLC can be withdrawn as dividends, which would prevent them from being double taxed or being subject to employment taxes. So when your single member LLC is treated as a disregarded entity, the self-employment tax applies to all your company's profits. Essentially, when you think about it, gaining S corporation status allows you to avoid paying employment taxes on dividends from your company. So this leads many people to believe that they should take all of their single member LLC money as dividends so that they can completely avoid self-employment taxes. No. Unfortunately, this practice is prohibited. You are required by the IRS to pay yourself a reasonable compensation. So applying for S corporation status for the sole purpose of avoiding self-employment taxes is not the best idea for a number of reasons. So the thing is, if you are serious about being treated as an S corporation, you should consult with an experienced attorney or CPA or EA to make sure that you have organized your LLC correctly, that your company is following all IRS rules, and that S corporation status would substantially benefit your LLC. Okay, and the thing here is that S corporations, are they taxed equally across states? Well, while tax advantages make the S corporation an attractive status, S corporations are treated differently by each state's tax laws. For example, some states treat S corporation like C corporation for state tax purposes, meaning that you'll only reap the benefits at the federal level. And a tax professional again can help you make sure that you are aware of your state's S corporation rules. So this is really important. You have to think about all these things before you actually choose your S corporation, and even if you have to choose it, to make sure that this tax election will benefit you not only in terms of tax filing but also optimizing your deductions and write-offs. Let's talk about the tax treatment. So how are S corporations taxed? S corporations do not pay federal corporate income taxes, so there is not really an S corporation tax rate, although they may get taxed at the state level. Instead, the company's individual shareholders split up the income or losses amongst each other and report it on their own personal tax returns. Okay, unlike regular corporations, what we call C corporations, this lets S corporation avoid double taxation. So double taxation refers to how income earned by a regular corporation is technically taxed twice. Once when the corporation earns income, and again when it actually distributes dividends to its owners, who then pay taxes on their own dividends. Okay, S corporation avoid this business tax by passing their income through to their business owners directly as reported on a Schedule K-1. This is why they are sometimes referred to as pass-through entities. And S corporation taxation depends on one important criterion: reasonable compensation. Okay, many single-member LLC owners find it really hard to determine what counts as reasonable compensation, and there has been court cases that have listed as many as 9 factors for determining this issue. So the IRS has a list of 10 factors that can be used to determine reasonable compensation. So the thing here is that based on our research, technically, accountants use a 60-40 rule whereby 60% of profit is taken as a salary and 40% as dividends. Another way to determine reasonable compensation is researching companies similar to your own with the U.S. Bureau of Labor Statistics. As an example, let's say you have formed a business 10 or 15 years ago as a single-member LLC. 6 years later, your LLC was formed. You decide to apply for S corporation status. In the previous year, we'll assume that your business was very successful and earned a net profit of $100,000. After doing the proper research, you discover that the typical salary for someone in your file is between 50 grand and 60 grand. So by paying yourself a salary of 60 grand, ensuring that you have paid your Medicare and Social Security taxes, and taking the leftover $40,000 profit in dividends, you should not have to pay any unemployment taxes thanks to your S Corp status. Okay, this is really important to really understand. Let's talk about the S Corp election. So how do you elect S Corp tax status? Let's really get granular here, okay? I'm going to spill all the beans so you have a clear understanding at the end. So to file or elect for tax corporation status, your business must be incorporated as a regular C corporation or have filed for LLC status. Remember, S corporation status is a tax designation. You cannot incorporate as an S Corp. If you are electing S Corp status as a C corporation, you must submit Form 2553, election by a small business corporation, to the IRS, signed by all of your company's shareholders. If you are electing S corporation status as an LLC, you will need to file Form 2553 again, okay? And you really want to make sure that you are filing the right form for your specific business legal structure. So here are the requirements for becoming an S corporation step by step. There are 3 important steps. Step number 1, become a C corporation or a limited liability company. Okay, so in order to elect S corporation status, your business must first be structured as a C corporation. So a C corporation is simply a regular corporation. And unlike S corporation status, incorporating as a C corporation is something you have to handle through your state. So to do this, you file articles of incorporation with your Secretary of State. Okay, this is really important. And alternatively, you can elect S corporation tax filing status if you are a limited liability company and if you meet the IRS's criteria for S corporation status. So that's step number 1. Step number 2, you need to make sure you qualify for S corporation status. Remember, there are some rules, so your company must satisfy the following requirements. It must be a domestic corporation that is based and operating in the United States. It can only have allowable shareholders. This means none of your shareholders can be partnerships, other corporations, or non-U.S. citizens. It cannot have more than 100 shareholders in total. It can only have one class of stock. For example, it cannot have a 2-tier common and preferred stock system. It cannot be an insurance company, bank, or a domestic international sales corporation. And all of the company's shareholders must unanimously consent to a S corporation status. That's step number 2. Step number 3, you need to file IRS form, and as I just said this, 2553. So once you have made sure that your company satisfies all of the IRS's requirements, you must file form 2553. And it must be signed again by all your company's shareholders. Let's talk about the tax filing itself. So, Form 1120S, U.S. Income Tax Return for an S corporation, is the tax form that S corporations and LLCs filing as S corp use to file their federal income tax return. And 1120S is a 5-page form from the IRS, which looks like we'll show this on the screen. So you will need the following information on hand before filing your 1120S. You have general information about your business, including your date of incorporation and the date you elected tax status, your S corporation status, your business activity code and your employer identification number, your EIN, and a profit and loss statement and a balance sheet for your business. You also need information about any payments you made to independent contractors, totaling at least $600 for the year, so each of whom you should have sent a 1099 miss form. So you can see on the screen here that page 1 of 1120S is divided in 4 parts, rather 4. So you can see on the screen, so you have the top third of the form containing fields A to F is where you will input your contact information, dates of incorporation, and S corporation election. Your assets also. So the income section will ask about all your company's revenue for that year, which is information you will get from your income statement. Go back to your accounting software to have more information about that part. Okay, this is really important. And you also have the deductions section, is where you will actually record all of your business deductible expenses for the year. And you have the tax and payment section, applies to corporations that began the year as a C corporation and filed for S corp status during the current tax year. And there are also 6 schedules attached to 1120S, the first 3 of which are mandatory. You can see on the screen here, you have a Schedule B, other information. You have a Schedule D. This is where you will report any capital gains and losses. So this is really important. And you also have Schedule K, which brings together, all the information about your business income, deductions, and any tax credits your business qualifies for. So this is really important. And you will use the information you bring together on this schedule to file Schedule K1 for each shareholder in your S corporation based on the percentage of total shares they own. There are also 3 optional schedules attached to 1120S. You have a Schedule L, which gives the IRS a snapshot of your business assets, liabilities, and equity. And you'll use your company's balance sheet to complete it. And Schedule L only has to be filed in by businesses that either had more than $250,000 in receipt this year or held more than $250,000 in asset this year. And you also need to think about Schedule M1 and Schedule M2. The deadline for filing Form 1120S is March 15th of the year. You can also apply for a 6-month extension by filing Form 7004, and you can file both forms electronically or by mail. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another session of the Awesome Sweetie Kiwi Show. We are still having a conversation about single member S corporation taxes. Let me just quickly give you the pros and cons of filing as an S corporation so you have a clear idea of the kind of stuff you are getting yourself into. Okay, so first things first, when we talk about the tax benefits of filing as an S corporation, no double taxation. You know, if you are a regular corporation, you have double taxation, but if you're an S corporation, you do not have double taxation. No self-employment tax. Unlike owners of sole proprietorships, partnerships, and LLCs, S corporation owners only pay self-employment taxes on their wages instead of their entire share of the company's profits. Okay, but there is a catch. You may wonder why S corporation owners don't just take a salary of $0 to avoid self-employment taxes altogether. The catch is that if you are a shareholder and an employee of the company, which most small business shareholders are, you must pay yourself what the IRS calls a reasonable salary before paying yourself a tax-free distribution. And what exactly is a reasonable salary? There are no hard and fast rules here, but you just have to look at the average in your industry. So the advantage of becoming an S corporation, you save on taxes. You have reduced tax payments if you sell. Okay, and if you ever decide to sell your business, you will pay a lot less in taxes when selling an S corporation than selling a C corporation. That's for sure. And in terms of the disadvantages of becoming disadvantages of becoming an S corporation, you have strict requirements. Though there's a lot of paperwork actually involved in handling an S corporation, but again, if you believe the benefits far outweigh the time, the investment in time and other resources, then go ahead and do it. You have a closer tax scrutiny, so the IRS actually keeps a close eye on whether the reasonable salaries corporate officers are paying themselves are indeed reasonable. And you also have an earlier tax filing due date. So pass-through entities, in other words, S corporations and partnerships, have an earlier tax filing deadline. So the due date for their tax return is March 15th, as opposed to April 15th for sole proprietorships, C corporations, and LLCs. Also, you want to watch out for different state tax rules. Okay, so while these advantages might make S corporation status attractive at the federal level, S corporations are not treated equally by each state. For example, some states choose to follow the federal tax requirements for S corporations, while states like New Hampshire, Tennessee, and Texas ignore S corporation status and tax those companies as C corporations. So the big question here is S corporation or not? Okay, should you elect S corporation status? Well, it really depends. Generally speaking, the decision should come down to whether or not you plan on taking profits out of your business or reinvesting them back into your business. So filing as an S corporation can lower your tax bill if you or any other owner plan on taking profits out of the company in the form of distributions. So if you are new and growing, if you have a new and growing business and intend to reinvest most of your profits back into the business, on the other hand, sticking to C corporation status can leave you with a lower tax bill. Okay, so this is kind of important. And so if you have decided to become an S corporation, it's really important to actually maybe talk to a professional first. Okay, and as always, it's important. The professional I'm talking about can be a CPA, can be an EA, an enrolled agent, can be it can be a tax attorney, somebody who understands the subtleties of business taxes in general. Okay, and it's really important to also pay attention to what we spoke about earlier in terms of reasonable compensation. Okay, it can be difficult to know when compensation is reasonable, and this is why you will always want to actually go by whatever is average in the industry, so that when the IRS asks you, you can go back and say, hey, listen, we got the data from this website, and the preferred method in our view is to go for the United States Bureau of Labor Statistics. In other words, you are picking data from a federal agency, so that if the data was published by a federal agency, chances are the IRS is going to honor it, as opposed to you picking the data up from a dodgy website or whatever. So it's always important to, if you want to think about reasonable compensation, to make sure that you are basing your research upon solid evidence. Okay, this is very important, because the IRS, again, as I said, there have been numerous court cases where the taxpayer was saying, hey, listen, I used reasonable compensation, and the IRS said no. IRS said the amounts are not accurate, and they're not reasonable at all. So you don't want to end up in court with the IRS. This is the last thing you should do. You should have right now. You better use your time to grow your business, scale your business, as opposed to engaging in court battles over taxation with the IRS. Thank you so much for your attention. I really appreciate it. I was just talking to you today about single member S corporation taxes. So we spoke about it. I gave you an overview. I talked to you about the implications, the tax treatment, the S corporation election, the tax filing, the pros and cons, and in the end, I just explained to you whether or not you should elect S corporation status. Thank you so much for your attention. God bless you. I will see you next time. Until then, remember, stay marvelous.